Today we're going to cover Rising Equity Glidepath, first introduced by Pfau and Michael Kitces in 2013, a dynamic asset allocation strategy specifically for the retirement phase. This fits in the overall framework of retirement withdrawal strategies under how we manage our portfolio, and specifically asset allocation, where static allocation such as the classic 60-40 is the more popular one. Join me as we examine the Rising Equity Glidepath, what it is, how it works, its pros and cons, and my personal take on its implementation. If you find topics like this helpful, take a moment to like and subscribe for future content. Your support is very much appreciated. What is a Rising Equity Glidepath? The Rising Equity Glidepath challenges the traditional wisdom of decreasing equity exposure as retirees age. In their 2013 paper, Pfau and Kitces suggest that increasing equity allocation over time can actually improve retirement outcomes by mitigating sequence of returns risk. Karsten Jeske, from Early Retirement Now, published a series of blogs in 2017 using historical simulation and came to slightly different conclusions, but the outcomes still indicate that selected glide paths do consistently outperform static allocations. What were their findings, and what starting and ending equity allocations provide the best outcomes? Pfau and Kitces found that starting with 20 to 40% equity and ending with 60 to 80% equity have the best outcomes in their Monte Carlo simulations when using historical average capital market expectations. In particular, the starting equity allocation of 30%, rising to 70%, had the best outcome. However, Jeske found that the 60 to 100% and 80 to 100% glide paths consistently outperformed using historical simulation. In fact, these glide paths significantly outperform other glide paths and static allocations, especially when the CAPE ratio and therefore sequence risk are both elevated. Interestingly, Jeske also found that the static 80% and 100% equity allocations outperform the 20 to 80% glide path. Again, this isn't consistent with Pfau and Kitces' findings. Just a quick note on those considering a 100% stock portfolio in retirement. You may want to check out my video where I discuss why this isn't for me. So, what accounts for the differences in the results? The simulation approach. Pfau and Kitces used Monte Carlo simulation, while Jeske used historical simulation. So how does Rising Equity Glidepath work? The reality is, sequence risk is limited to the first 10 to 15 years of retirement, and maintaining a substantially lower equity allocation has little utility after this point. In fact, maintaining a smaller equity allocation introduces longevity risk, since your retirement savings may struggle to keep pace with inflation. The Rising Equity Glidepath instead keeps a higher bond allocation in the first 10 to 15 years, which reduces the need to liquidate equities at depressed prices in this period, after which it increases equity allocation. Looked at from another view, this creates an equity ravine, if you like, a temporary dip in your equity exposure specifically to protect against sequence risk, then you reallocate back to equities after the sequence risk period typically recedes. Kitces and Pfau originally proposed increasing equity allocation over the retirement period of 30 years. However, in a later paper, they found that accelerating the equity glide path over 15 years could provide even more favorable outcomes. Jeske found that accelerating this further to around 10 years could provide a further improvement to the withdrawal rate. Let's get into some practical considerations when adopting the Rising Equity Glide Path. We've touched on the first. What's the period over which you will increase your equity allocation? The historical simulations from Jeske suggest 10 years as being a good starting point, but 10 to 15 years is reasonable. However, let's also not forget the pre-retirement preparation to build a bond tent. You'll want to start gradually reallocating to bonds, at least 5 years out from your retirement date, and not leave this too late, in case of an unexpected bear market just before you retire. Next, there's the question of how and when to reallocate your portfolio towards equities. There are broadly 4 approaches. First, do nothing. You simply spend down your bonds. This reduces the bond allocation while allowing equities to grow. Second, annual reallocation involves setting your new allocation and simply rebalancing. Third, opportunistic reallocation involves using valuation-based rules to reallocate. This requires the most effort in terms of monitoring and analysis. Finally, you could use a hybrid approach, combining the 3 methods above. Are there scenarios when the Rising Glide Path performs worse than a simple static allocation? As Jeske put it, the approach is essentially an insurance policy against sequence of returns risk, so it performs best when there is an early bear market. While this strategy aims to maximize your chances of retirement success, it's not designed to maximize wealth, particularly if you experience a strong bull market early in retirement. This brings to mind one of William Bernstein's quotes: "If you've won the game, stop playing." Here are Jeske's findings, comparing the active rising glide path of 60 to 100% to static allocations, during some of the worst and best times to retire. I've created a version of his table by removing 100% equity allocation, because I don't think most retirees would be able to stomach this, and the fact that it has some really poor outcomes in bad years, unsurprisingly. I have also calculated the delta between the glide path option to the best and worst static allocation options. In a bad market, the glide path option is consistently the best, and sometimes by a significant margin. In the Great Depression, the glide path option enabled a safe withdrawal rate of 4.23%, which is 34.75% higher than the static 80% portfolio, at 3.14%. That's a massive increase. You see similar patterns for the other two more recent periods, retiring in 1966 and 2000. However, in a strong market, it underperforms static allocations, sometimes significantly. But this is a reasonable trade-off. Ensuring that your retirement savings will last in a bad sequence of returns is far more important than eking out that final bit of withdrawal. That said, it's important to remember there are numerous complementary strategies that you can employ to make your retirement savings last. I discuss these in detail in another video, and some of these are incredibly simple but remarkably effective. We have covered the pros earlier, so I'll keep this brief. Having a larger allocation to bonds can help mitigate sequence of returns risk by providing a larger pot of less volatile assets you can draw from in earlier retirement. The lower volatility can also offer significant psychological comfort, especially for those with lower risk tolerance. Jeske found that there is generally lower variability, and therefore more stability, in the terminal wealth when using the rising glide path compared to a static allocation. And by setting aside a larger bond allocation early in retirement and ensuring your spending plans in your active go-go years are covered, you can align your portfolio with those plans. This enables you to enjoy your early retirement without constantly worrying about market downturns. The timing of reducing your bond allocation is also aligned with state pension kicking in 10 or so years later for those planning to retire early, which reduces your dependence on your retirement savings at that point. There are a couple of cons, and I'll spend a little more time here. First, a number of articles on Rising Equity Glidepath, including those by Pfau and Kitces, have acknowledged that it is counterintuitive. This is a potential blocker to mindshare and uptake by the average investor. However, as Jeske noted, those considering FIRE and early retirement are likely to be more financially literate than the average 85-year-old. Second, you need discipline and a strong stomach to persevere with this strategy, due to its counterintuitive nature. And this introduces behavioral risk, which is something I feel strongly cannot be overlooked. If you lack the discipline or the confidence to increase your exposure to equities later in life, you could be locking your retirement savings in a high fixed income, low equity allocation, which could have an adverse impact on the longevity of your portfolio. The psychological element cannot be overstated. This is the same criticism I had for the 100% stock portfolio in retirement, recently championed by Anna Kulova, Sederberg and colleagues. On that note, it's also interesting that Jeske found that the glide paths with the best outcomes were 60 to 100%. You will need quite a strong constitution to stomach a 100% stock portfolio in retirement, with 20 to 30 years ahead of you. Third, a practical challenge for adopting the Rising Equity Glide Path is the limited support within standard retirement planning tools. While strategies like Geitenklinger guardrails benefit from robust integration in the planning community, the lack of tool support for a rising equity glide path is a real drawback. It makes it harder to feel confident about your plan and increases the risk that you might choose a glide path that's poorly suited to your needs, with no reliable way to evaluate, compare, or stress test your options. Fourth, while the Rising Equity Glide Path does require more active management, it's arguably no more complex than adopting a dynamic withdrawal strategy, like the Vanguard Dynamic Spending Rule. Interestingly, Pfau and Kitces acknowledged that the simple 60-40 portfolio is remarkably effective. In fact, they described it as nearly optimal, in most situations, even compared to the glide paths they analyzed. Jeske, on the other hand, found that static 80-20 portfolios achieved almost identical safe withdrawal rates to the 60 to 80% glide path. So given how close the outcomes are, it's worth asking whether the additional effort is the best use of your time in retirement. David Blanchett's research showed that applying a modest 1% inflation haircut could increase your initial withdrawal rate by 10%, while still preserving a 90% success rate across a range of balanced portfolios. That alone exceeds the glidepath's edge over the static 60-40 portfolio in Jeske's analysis, when looking at the 10th percentile. And let's not forget PGIM's recent research, which found that 85% of retirees have more flexibility than previously thought, and are generally willing to reduce spending by 20% when needed. If you're already considering a dynamic strategy like Geitenklinger or Bengen's floor ceiling, you may already have strong defenses in place against sequence risk without needing to add the complexity of a rising equity glide path. Finally, there's a strong dissenting view from Javier Estrada. In his 2015 paper, The Retirement Glide Path, An International Perspective, Estrada analyzed declining equity, rising equity, and static glide paths using international data from 19 countries and the world market over 110 years. His conclusion? A simple 60-40 stock-bond allocation is not only straightforward but highly effective. In fact, his summary table shows that static strategies, on average, outperformed both types of dynamic glide paths by a significant margin, directly contradicting the findings of Pfau and Kitces. Looking across all scenarios, the declining equity glide path consistently beat the rising one, with an average failure rate that was 30% lower. For US-specific data, the difference was even more pronounced, with declining glide paths outperforming rising by nearly 60%. Estrada's findings also contradict Jeske's analysis, which was published 2 years later. Unfortunately, Jeske doesn't appear to address Estrada's research in his blog, but when we drill into the differences between rising and declining equity glide paths, Estrada's findings are clear. Rising equity glide paths consistently underperformed. For example, comparing conservative paths like 70-30 versus 30-70, the rising glide path had an 18% higher failure rate. The differences may stem from the methodology and datasets used, but this raises a question whether further analysis is needed from more researchers before I'd feel comfortable committing to this in my own retirement. Let's wrap this up. Would I use the rising equity glide path personally? Probably not, and here's why. While it's a solid strategy that addresses sequence of returns risk, just set aside a portion of your portfolio in less volatile assets. It's not the only solution. There are simple, highly effective strategies like inflation haircuts and cutting discretionary expenses that work just as well. I cover these and other approaches in a separate video, which I'll link in the description. Also, if you're planning to use a dynamic withdrawal strategy, you could add the rising equity glide path, but does it really make sense? Combining two complex strategies, one for withdrawal rates and the other for asset allocation, feels like overkill and way more effort than it's worth. Second, it's interesting that Pfau and Kitces compared the rising equity glide path to the bucket strategy in their 2013 paper. While the two share similarities, like relying on less volatile assets during downturns, there are two key differences. First, bucket strategies use a fixed asset allocation based on time segmentation, while the glide path follows a predetermined shift in allocation over time. Second, the bucket strategy requires periodically refilling cash and bonds, a sometimes messy process, whereas the rising glide path simply relies on rebalancing. If you've been following this channel, you'll know I've discussed the simplified bucket strategy in another video. This is a straightforward two-bucket structure with 6 years of expenses held in short-term assets, overlaying a 75-25 total return portfolio. That short-term buffer helps manage sequence of returns risk, with 75% still invested in equities for long-term growth. It's flexible, so you can extend that 6-year buffer to 8 if you prefer more safety. Personally, I think the simplified bucket strategy hits the sweet spot between simplicity and effectiveness. It sidesteps the complexity of bond tents, glide path adjustments, and fiddly bucket maintenance rules. And remember, this is purely an asset allocation framework. It doesn't dictate how much you should withdraw, or how to adjust withdrawals based on market performance. That's where dynamic strategies like Bengen's floor ceiling come in. If you've made it this far, thank you. I'd love to hear your thoughts. Are you considering a rising equity glide path for your own retirement? Let me know in the comments below. And if this was helpful, please hit like and consider subscribing for more retirement planning content. Thanks again and catch you in the next one.